when you look at these companies that are really priced for perfection, as it were, a lot of them in the current market tend to be either very high growth companies or, as we've chatted about, the defensive companies that have very stable earnings. And so with the high growth companies, often I'm not sure whether investors actually take into account that growth doesn't come for free. And so when companies are promising high growth rates, or when it looks like a particular sector is going to benefit from certain tailwinds, macroeconomic tailwinds, demographics, whatever it might be, companies need to invest in order to generate that growth. And so, what might translate into revenue growth over time might not necessarily translate into earnings growth or growth in free cash flows. And ultimately, as investors, what we're buying from the company is the free cash flows that it can generate for us. So I think it's important not only to focus on what the growth might be, but how much you actually pay for that growth, both in terms of the capex that the company needs to spend to generate that growth, but also what you as an investor pay as the price for that stock today. And what does that share price today imply about what the company needs to deliver in the future? I think there is a bit of a misconception around what contrarian investing actually entails. Generally we find that low PE is correlated with cheap, but not always. Recently we've bought a couple of stocks in the portfolio, New Farm and Incitec Pivot, which on current earnings were trading at around PE of about 20 times for New Farm and 40 times for Incitec Pivot. And the reason that we were buying those is because we don't really focus on current earnings, but we try to do a lot of work to understand what would be the normal earnings or the average earnings for those companies. And so in our view, the current earnings for those companies are quite depressed, but normal earnings for those companies should be substantially higher than where they are currently. And so if you plug in those normal earnings into the PE equation, you actually get to a reasonably low PE. And so as a result, we think those companies are cheap, and we've been willing to invest in them even at these high PEs.